Welcome to the channel. We're going to kick this off with an article about CBL. Specifically, I want to highlight the last strong buy rating for CBL before the company declared bankruptcy. This is an objectively terrible piece of analysis. The article includes the assumption that the REIT could simply stop all redevelopment activities immediately. I haven't seen that happen. That's just not a thing that actually happens. REITs don't stop redevelopment effective immediately. They will scale it down in response to swings in the stock price or the need for liquidity. But if you see a REIT stopping all redevelopment immediately, they're probably headed for bankruptcy. Next issue. The analyst wanted to slash the amount of recurring capital expenditures. Recurring capital expenditures, also known as maintenance CapEx, refers to the amount spent for things like replacing roofs or repaving a parking lot. There's only so much a REIT can do to reduce those expenses. Generally speaking, if you see that recurring maintenance CapEx is plunging, that's a sign that you really need to dig much deeper into what's going on here. You can look at recurring maintenance CapEx generally as a percentage of revenue or a percentage of net operating income. There should be a little bit of volatility over time, but not an enormous amount. You certainly wouldn't expect a REIT to be able to slash it by 30 to 50% sustainably. So the thesis in this article effectively planned for CBL to pay out all of their cash up to the point where they would eventually have to declare bankruptcy. Now, as you might imagine, creditors really hate that. They try to structure agreements to prevent a company from spending all of its cash and not being able to pay back debts. If that wasn't a thing, you would see companies proceed to just borrow a bunch of money, pay out dividends, and declare bankruptcy. Clearly, the underwriters aren't that stupid. Next issue. He has two questions with management, and management responded very quickly. The first question is the one I want to focus on. He asked management about their mistake in acquiring some Sears properties. Management's answer didn't admit that it was a mistake. They actively defended their decision. It was a terrible decision. They bought these properties from Sears before Sears could enter bankruptcy, and if they had just let Sears enter bankruptcy without buying the properties, they could have, I know that sounds crazy, they could have just not bid on the properties. The issue with buying those Sears is not only did they end up paying for the Sears location, they also had to spend an enormous amount on redeveloping the property. Unless they were going to buy a Sears and just have it sit vacant, which would not be a useful plan, that's terrible. So if another tenant were to buy that lease out of the Sears bankruptcy, that tenant would just get to take over the Sears lease. CBL wouldn't have any responsibility to spend new development money on that property. The new tenant would have to deal with things like putting up a sign that doesn't say Sears died here. So that was an objectively terrible decision by management. They didn't have enough cash to make that move and remain in a strong financial position. To be clear, they were not in a strong financial position before they spent money to acquire those properties. In no way should they have bought those properties. Dumb mistake, and management denied the mistake when they were asked about it. That should have been a red flag for the analyst. And I'm using the term analyst generously. Let's put it like that. To be fair, after this last strong buy rating on CBL before they declared bankruptcy, the author did do one thing that I could certainly respect. They quit publishing. They never published another article. So, what else do we have? They brushed over the decline in same-store net operating income. This was a huge decline. They were running around 6% year over year for the decline in same-store net operating income. That's a huge red flag. It's okay for there to be an occasional decrease in same-store net operating income, but it should be really, really rare. It was not rare for CBL. This was happening quarter after quarter. The issue here isn't just that same-store NOI was falling by about 6%. That sounds bad on the surface, but same-store NOI is only reflecting the pool that has been labeled as same-store. That can be a problem in these situations. If a REIT is objectively failing, and CBL was failing, one of the things that the REIT will do is put properties into redevelopment. When the property goes into redevelopment, it's not part of the same store pool. At least, generally, it won't be part of the same store pool. There could be some exception somewhere, but typically, it's been removed from the same store pool. Well, you're taking your worst properties and putting them in redevelopment. Therefore, your same store NOI figure should have a slight positive bias. Despite being able to remove some of their worst properties, they were still running around negative 6%. That's horrible. You can't just brush over that. But he did. The next thing is a comparison for net debt between several REITs. And what we're looking at here is leverage in the form of net debt to EBITDA. That is a useful metric to use, but it can be misleading. In this case, the issue is that the EBITDA is essentially being inflated. So the peers were companies that owned much higher quality properties. A low quality property is going to trade at a high cap rate. So for instance, $100 million of a junk property might trade at a 12% or 15% cap rate. That means the $100 million property could be producing $12 to $15 million of net operating income per year. To some investors, that's going to sound like an amazing deal. But the reason the cap rate is so high is because that net operating income is expected to plunge. The real estate investors are not stupid. The value is low because the property is flawed. Either the net operating income is going to plunge, or the company will need to spend an enormous amount of money on redevelopment. CBL didn't have an enormous amount of money for redevelopment. So that meant the net operating income was going to plunge, or they would need to sell the property. Not a great situation to be in. The peers that were selected were technically mall REITs in most cases, but they owned much higher quality properties. Those properties may have traded with cap rates in the 5% to 8% range. CBL had a bunch of properties that would trade in the double-digit range. Because they were producing more net operating income, they would also have a higher value for EBITDA presently. So when you think about the income statement for a equity REIT, in general, what you're going to have is revenue minus the property operating expenses gives you net operating income. Subtract out the various overhead costs like paying management, and you're going to have EBITDA. Now that is a simplified example. There are going to be some variations, but it gives you a general feel for things. Since net operating income was going to be inflated for these properties relative to where net operating income was projected to be in the future, we could see that there would be a negative trend to it. Bad sign. Because net operating income was so elevated relative to the value of the assets, EBITDA was also elevated relative to the value of the assets. Therefore, the value of the assets relative to net debt was much lower than it would have been for a company that was producing their net operating income and their EBITDA from properties that had a higher valuation. And again, you don't have to agree with the market about every aspect of valuation, but if the underlying real estate is trading at double-digit cap rates, it's probably not the greatest real estate. That's particularly true when debt is very cheap. So if you see the 10-year treasury at like 1%, or even if it's under 2%, well, you're probably going to see lower cap rates on real estate. And when you see the double-digit cap rates, you should be concerned about where that net operating income is going to trend in the future. So those were the mistakes that led to the author, I can't use the word analyst there, the author to project that CBL's $2.50 share price involved upside of around 200%. As it turned out, the share price actually had downside of about 100%. Shares were basically worthless. They may have paid a few dividends between when the author wrote the article and the company cut their dividends entirely, and subsequently when they declared bankruptcy. To be fair, the pandemic did play a factor in the company declaring bankruptcy, but they were firmly on track to end up in bankruptcy before the pandemic. Without the pandemic, they would have lasted longer, but the real estate was junk. So that is our first review of a terrible article.